All right, we've entered a new year, so we're looking forward to what to expect for Canada's markets and the economy. Our next guest thinks this year will be one of resilience and opportunity, with GDP expected to grow and inflation contained. Here to expand on that is Ashish Dewan, Senior Investment Strategist at Vanguard Canada. Ashish, thank you very much for joining us.
Happy New Year, Roger.
And Happy New Year to you as well. Thank you. You're an optimist for the start of the year, GDP especially. What's fueling that optimism?
Well, we actually think that the AI is going to give the economy a boost. But on the market side, we actually feel that the markets might be pricing in too much perfection. So, in the near term, actually, we think the growth is really going to come from the investment spending side. And that's really going to boost GDP growth in the U.S. We also believe that there are going to be other influential factors shaping up in 2026. On the demand side, we have monetary policy. We also have on the demand and supply side, fiscal policy, and then there's what we actually categorize as mega trends, and these are, things like globalization, demographics, debt, and AI. Slow-moving supply side factors, which have a profound impact actually on the economy. So given all that, we actually think that near term, there's going to be growth from investment spending in the United States, and that's going to also benefit Canada. But in the longer term, actually, once AI does diffuse across various sectors, we'll actually see more productivity gains. There are obviously risks in the market. We see that valuations are stretched. And risk is actually concentrated in only a few firms. We see that the top 10 firms in actually the S&P 500 are now 40% of the index. And so if AI actually disappoints, some of these stretched valuations could actually unwind, and we could see AI sort of plateauing at a lower plane. So we do see opportunities, and we see opportunities in U.S. value, developed ex-U.S. stocks, and also in fixed income, particularly Canadian credit.
All right, lots of questions. First up, the investment spending. What makes you think that's where the money's going?
Well, we've seen that the AI hyperscalers have actually committed $2.1 trillion into 2027. So we really don't have a reason to doubt them. We think they'll come through on their commitments. And we've actually charted out, past build-out cycles, major capital cycles, and we do feel that this one is similar to some of the past cycles. We do think we're in the early stages of the cycle. So the key question is this big or is this small? And what we have seen, looking at share of GDP from past build-outs, is that this cycle is going to be similar to past cycles. But there's still a lot of range of outcomes, and we actually think we are in year 3 of an 8-year investment build-out. And the past cycles I'm talking about are, the post-World War II autos. You have the 70s and 80s oil exploration build-out. So the key message is really we're only 20% to 40% through in terms of the cycle, and there's still significant investments ahead.
Now, you didn't mention the .com, though. What makes you confident that it's not that?
Well, I think comparing it to .com, for example, that was in the late 1990s, and valuations are stretched at this point in time. But a lot of these companies are actually fairly good in terms of having good free cash flow. They also have strong balance sheet. We think that actually, based on our fair value, if you look at things like the Vanguard Capital Markets model, which looks at interest rates, the neutral rate, the long-term rate of inflation, we actually think that the market is a little bit overvalued right now. But if you look at kind of some of the consensus estimates of earnings growth, which are about 10 to 15%, and if those do actually materialize, we do think that the market could be fairly valued, but this really assumes that AI delivers perfectly and there's very little margin for safety.
Okay. And with AI, you say longer term AI is going to start kicking in. Is it that companies are now adapting this full force?
Well, so we're still, as I mentioned, in the early stages, Roger. So, it's going to take some time. So our view is really AI is going to diffuse across different sectors. So, the first stage of a cycle like this, it's usually the builders that benefit. And we see companies such as, the Mag 7 companies really benefiting. But really, it's that we're in phase 2 right now. And it's really that, technology is going to diffuse into different sectors. Hospitals are going to use it to improve productivity, for example. You'll see it disseminate across the manufacturing sector, the educational sector, and that's really a strong boost to what we consider sectors outside of where the technology originates, so outside of U.S. growth, and that's why we're more optimistic about developed ex-U.S. Equities as well as U.S. value stocks.
Okay, we're going to have to wrap it up there, Ashish, but thank you for joining us, and again, Happy New Year to you.
Happy New Year, Roger.
Ashish Dewan is a senior investment strategist at Vanguard Canada.